Good afternoon, everybody. My name's Dave Price. I'm the Director of Sales at Rock Advisors, and welcome everybody to our webinar, A Field Guide to CMHC for Apartment Development. So today we have got a number of things on the go for you. We've got some great guest speakers, but before we get started, I just wanted to let you know up on the screen, as always, we've got timely webinars coming up, and I just want you to be aware of March 24th, we're doing the webinar on financial fundamentals of apartment development, and that's part one in a series. So you can scan the QR code there, but stay in touch with the timely webinars and information that we're providing to our audience. Now, today's agenda, we're going to get into a number of in-depth topics. We're gonna have a run through of the CMHC programs, bring definitions. We're going to get into a case study to do an analysis of the financial impacts of the different programs. And then we're going to get into some strategies and insights. And we're going to conclude the webinar with a live Q&A session. So that's what we're going to cover today. And now, at the end of the recording, we usually get the question asked, will the recording be available? Absolutely. We'll send out an email at the end of the webinar and you'll be able to rewatch the replay on our landing page. Now, moving right along. This topic is a hot topic, very timely. Please use the chat box in the Zoom, in Zoom. Send in your questions early. We're going to have a Q&A session at the end of the webinar. We'll try to answer as many as possible, but the ones that we can't get to, we'll answer them. We'll get the experts involved based on the topic to get those answers to you after the webinar. Now, I'm going to introduce, this again, this is a difficult and challenging topic, and this isn't something that we can typically do on our own. So we bring in the experts, the heavy hitters. We've got three great panelists that are gonna weigh in and bring their expertise to the table today. We've got Alexander Durant, the head of underwriting at M Commercial. We've got Navendu Dagra. He's the Senior VP of Business Development at CFO Capital. And we've got Joanna Zhao, she's a mortgage broker with the Mortgage Group. And each of these three experts are brought in often to our clients' accounts to weigh in and help with underwriting for construction loans and takeout financing. So it's great to have you all on board. Now we're going to dive into things. So Alex, I'm going to turn it over to you first. You're going to walk us through some of the CMHC programs, but Alex, maybe you can start off with a 20-second elevator pitch on what M Commercial can do for our prospects and clients.
Absolutely. Thank you, Dave, for the introduction. It's very nice being here with everybody. I'm Alex Duran. I'm with M Commercial mortgage broker with them. Our firm does all commercial mortgage financing. Obviously, for the past few years, it's been very heavy on CMHC and development, but we touch industrial, office, owner-occupied. We have specialists in all types of financing, but today we'll be focusing on development and specifically CMHC and what options you might have with CMHC. Some are well known, some are a bit less well known, but we'll give you guys an idea of all of that today. Before we dive into the programs, I wanted to just give everybody a general overview of CMHC's guidelines and requirements. To start off, we'll jump right into the borrower eligibility. So for CMHC, especially on construction, these next few points, they dig into very heavily, and they're very important to know ahead of time. So for the borrower, for them, it's very important that the borrower group has competence and experience with the same size and property type of the request. For example, if you've been a developer for a number of years and you've done a lot of single-family homes, duplex, triplexes, maybe some 5 and 6 units, but now your request is for a 100-unit property, CMHC isn't going to recognize that as sufficient experience. They're not going to go ahead and approve it as is. There's ways to mitigate that, right? You could be hiring a GC with the experience, with the track record to do so. But we have to look in these ahead of time in order to just optimize the request and go through go through the CMHC process as smoothly as possible. It's the same thing on the management side. CMHC wants the group to have at least 5 years of experience in operating similar sized multi-residential properties. If we don't have that because it's a larger property and you've done it for some smaller ones, again, CMHC could approve it with the contingency of you'll need a third-party management firm to at least be with you for the first few years to help on that end. The next guideline for CMHC is a net worth. I think this one, especially right now, was one of the most important ones for CMHC. They spend a lot of time and have been very strict on what is the net worth of the group. The general guideline is going to be that the group has to show a combined net worth of 25% of the loan amount or a minimum of 100,000. But what counts as the net worth? That's where CMHC has been digging in. And for them, it's going to be only assets which are held directly by the individuals, the co-borrower, and the corporate borrowers and the corporate guarantors, and nothing else, right? Which means that investments held in privately owned companies will be considered at 0%. What this means specifically, because it's not very clear, a borrower structure that we see very often, a very popular one, you'll have your holding company, and for every project, you'll create another company for that project specifically. If those projects are all separate and they're not attached in any way, except from the holding company, your new project, CMHC won't be able to consider the net worth of your previous projects unless they're added on as guarantors to this specific request. Net worth, CMHC will only consider net worth from directly owned assets from whoever specifically on this new request. In the past, we've seen it where they've been a bit more lenient, but as of today, they're very strict on this. So very important to know if you're making new requests today. Other assets that are can be considered, well, RRSPs and RESPs, they will consider them only at 50%, but other assets such as vehicles, furniture, jewelry, and art, they won't consider at all in the net worth. Next is the guarantee requirements. For construction loans, CMHC is going to require that during construction, the group is guaranteeing 100% of the outstanding loan amount. And once construction is done and you've been stabilized for 12 consecutive months, that can be reduced to 40% of the outstanding loan amount. We'll go into a bit more detail a bit later on this. There are some exceptions depending on programs. However, if you're in the standard program, there is a way to avoid some of these guarantees, and that's if the loan amount is less than 65% loan to value. In those cases, you can get a non-recourse loan, and the definition of non-recourse for CMHC is where the recourse is only limited to the property itself. Last requirement, just before getting to the programs, is all items specific to construction for CMHC. First one being, and we get this question a lot, is when can I submit my request to CMHC? CMHC's answer is broad, but they're basically saying that you could submit any time, but you just have to make sure that by the time you get approved, that you get your certificate, you have to be able to draw within 6 months, because after 6 months, your certificate is going to be expired and you won't be able to use it. They even give the example that if everything could get done in 6 months, you could even submit your construction request before you close on the purchase of the land, right? You just have to make sure that everything tees up. I know that's a very rare thing where you go through all permitting and get done within 6 months, but for CMHC, they just want to make sure it's that 6 month is respected. And one new requirement is the environmental reports. We now need to submit the environmental reports at the beginning, which means your phase 1 needs to be done. If you have a phase 2, your phase 2 needs to be done. However, you don't have to have it cleaned by the time you submit, right? This CMHC just want to see if the risk contamination was the extent. Again, going back to them making a judgment that can you clean it up in time to respect the 6 months? Because it does need to be cleaned before the first draw, right? You can't use the CMHC financing to do your cleanup. It has to be done before. Next requirement is that your demolition and decontamination costs cannot be included in your budget. And the last one that is looked at, again, very in depth by CMHC is the liquidity. So CMHC and the lender they're going to require to see additional liquidity by the group of about 10% of hard costs. It can be more in some cases. Usually when a group has more than one construction project at the same time, they'll like to see a bit more. But if your equity requirement based on your loan to value approved was 1 million, well, they might want to see another 700,000 depending on your hard cost above that you don't have to put in, but they just want to see you have it on the side somewhere in case something happens during construction.
Sounds good. Now, Alex, before you move on, I've got a question for you.
Yes.
Um, and this has been posed to me a couple of times. You were just talking about the guarantee and the guarantor. Um, is there any impacts? Does CMHC and other lenders look at foreign entities differently as it relates to supplying the guarantee, the covenant? Is it different for foreign individuals and entities?
It is. So CMHC can accept requests from non-residents.
Okay.
However, it has to be a non-recourse loan, right? So if you're in the standard program, you can't go above 65% loan to value because it has to be non-recourse. Um, it could be MLI Select, but again, you would have to achieve enough points and be experienced enough for them to approve the exception of it being non-recourse. So they can go to CMHC, but a lot of times they won't be able to get the maximum. If
Gotcha. So probably pretty important that they partner with somebody boots on the ground that maybe has some experience with projects in Canada.
exactly, and just as a quick note on that, because it ties into the net worth. Um, when they're making the calculation of the net worth, they're only considering assets in Canada as well, right? So if you own real estate in the States or overseas, that doesn't count either, even though it might be held directly by the guarantors or the borrower. It's only assets in Canada that count as well.
Gotcha. Okay, thank you for that. Carry on.
Perfect. So now we'll go through some of the more popular CMHC programs. We're not going to go through all of them, but just the main ones that we see most often, or that maybe we don't see as often, but are just as good and should be considered. The first one is the Mortgage Loan Insurance, MLI, which is their standard program. It's been there forever. They make changes now and then, but this is the standard program. General highlights are loan to value for construction. You could get up to 85% of lending value as determined by CMHC. And you'll see this phrase as determined by CMHC quite often here because it is different than, let's say, your appraised value. We do have to supply appraisals, but CMHC could disagree with some stuff in the appraisals, such as rents, expenses, cap rates, and determine their own value. And this is where they're basing their loan to values off, is what they consider as the lending value and not an appraisal or a market value. So we could get 85% of CMHC's value or 100% of costs, whichever is less. And if the project does have non-residential portions, those portions are capped at 75%. Loan advancing in the standard program, well, during construction, you can get up to 85% of costs or of lending value, whichever is less. Which means if you did qualify for 100% of costs, you'll only get 85% of that during construction, and the rest will be released upon completion. Debt service coverage, a few different options here. If it's smaller properties, 5 to 6 units, your debt service coverage is going to be 1.1. For larger properties, 7 plus, it'll be 1.2 if your term is 10 years or more, or 1.3 if your term is less than 10 years. Non-residential spaces, it's 1.4 for the 10 years and 1.5 for less than 10. Interest rates, there's both fixed and floating rates available. It's going to be dependent on which lender you choose to go with, what they have available, but CMHC works with both. And it's important to know that when they approve a deal, they're going to put a maximum ceiling rate. This should be considered before you submit, because whatever rate is used as a ceiling rate is going to appear in your COI, and you won't be able to fund your deal if the actual rate is higher than that by the time you convert to your long term. So always important to discuss that with your broker or lender, just making sure that you are applying a proper ceiling rate and you have room if something happens in the market. And on interest rates, even in the standard program, rates are generally lower than CMHC, not than CMHC, sorry, than conventional. I'm saying generally because it is based off of location, what lender you're going with, what the size is, because some lenders are going to be more competitive in good areas, larger projects. But if you have a small building in the middle of nowhere, maybe there's not many lenders that go there, and if there's not many bidding, then they won't be as aggressive. So you might have similar to conventional rates, but generally you'll have very advantageous rates on even on the MLI Select and the standard. And amortizations, you could get 40 years or even 50 for construction as well. Some advantages of the standard program is during construction, you'll have no rental achievement holdback. You'll have a property with better cash flow once completed. CMHC will have no control over your rent increases when you're done. You might have some control from the municipality or the province, but CMHC won't have anything to say. And your COI is valid for the entire life of the loan, unless you refinance. So it's not just good for your first term, your first 5 years. If you choose to just keep it and just renew, and you have a 50-year amortization, your COI it covers the entire amortization. A quick note on the program specific to construction. Bonding is required for construction in almost every deal. Bonding is a additional construction insurance, and CMHC will want this in place for most construction deals, but it can be replaced in most cases, usually by either a reduction in the loan amount by 10%, providing collateral securities in the amount of at least 10% of hard costs, or providing a letter of credit in the amount of at least 10% of hard costs. The next program that CMHC has, and this is probably the most popular one, I think everybody has heard of this one, is the MLI Select. It's been now just under 3 years that's been in place, and it's been very, very popular, like I said. Loan to value wise, you can go higher. You can get up to 95% of costs for the residential portion and 75% for the commercial. Loan advancing, you can get your entire 95% during construction. You're not going to hold back anything. Debt service coverage ratios are also reduced. You'll be able to get 1.1 for standard rental or 1.2 for other shelter models, such as seniors residence, student housing, single room occupancy, which could also be done in MLI Select. And your non-residential space will be calculated at 1.4. Interest rates, again, you'll have fixed and floating both available with your lenders. And same thing as before, a ceiling rate will be put in place. And when you do provide some affordability, because this program is focused on affordability, accessibility, and climate compatibility, lenders will be more aggressive on the pricing when there is affordable units in the project. Amortization, you could get 50 years as well, depending on scoring. And we'll go quickly through the scoring a bit later as well. Some advantages of the MLI Select compared to the MLI Standard is higher leverage, lower debt service coverage, which is going to allow for a higher loan amount if that's what the priority is. You'll also get a discount on your CMHC premiums, anywhere from 10 to 30%, depending on scoring. In the MLI Select, you can get a non-recourse loan, depending on your scoring and who the sponsor is. And again, your COI is going to be valid for the entire life of the loan as well. No need to come back unless you want to do an equity takeout or refinance. Quick notes to this program is there can be a rental achievement holdback. What is the rental achievement holdback? It's a holdback that CMHC could put in place to hold funds during construction until you're rented, until you meet the underwriting rents. When does this come in play? Well, if your loan to value is higher than 95% and your debt service coverage is lower than 1.2% on the request in question. In those cases, they will put the rental achievement in place, typically up to 10% of the loan will be held back during construction and released, like I said, once you're rented up. Bonding is also a requirement in this program. Thank you. It can be replaced with the same vehicles as before. And now we'll jump into the scoring quickly. Like I mentioned, this program covers accessibility, affordability, and energy efficiency. And you could get points for each. For the accessibility, if you do choose to go that route, because you don't have to provide all of them, you just need to get whatever points you want on a maximum of 100 in order to go get different flexibilities from CMHC. So for accessibility, there's a general requirement, which is if you choose accessibility, the entire building and all units have to be 100% visitable, and the common areas have to be barrier-free in accordance with the CSA standards. What does visitable mean? It's units that allow for a person to enter safely, maneuver throughout the unit, and to use the toilet facilities. So even though they're not accessible, they still need anybody that might have difficulties, such as people in a wheelchair or that are temporarily injured, to be able to go through any unit. And then in order to get those points, you also have to provide for level 1, 15% of the units actually being fully accessible under the CSA standards, or 50% of the units being of universal design. Universal design is a guideline that CMHC put in place. On their website, they do have a document that goes through in detail what's required in order to be considered universal design. Or you could also qualify by using the Rick Hansen Foundation and getting a certification of 60% to 79%. This is typically a simpler process and a more straightforward process to go get your points is by using the Rick Hansen Foundation accessibility certification. You could also get 30 points by providing more accessibility, either 15% as accessible with the CSA standards and 85% as universal design, or 100% as universal design, or 100% as the CSA standard. And again, you could also use Rick Hansen Foundation with a score of 80% or more. The next scoring is going to be for affordability. There's 3 levels for the affordability to get 50, 70, or 100 points. And these are going to be specific to new construction, because existing properties will have different criterias for these social outcomes. Level 1, you need 10% of your units to be at the affordable rents. Level 2, you'll need 15%, and level 3, you'll need 25%. What's important to note is what determines your affordable rents. Well, it's CMHC. They provide a list to the lender that's based on location, what your maximum rent is going to be. For example, if you have a project in Toronto, it's going to be $13.47 is going to be your max rent. If you're in Montreal, it's $10.90, and so on. There's a specific number for every single city. If that city is not there, CMHC suggests to use the closest one, or sometimes it's considered rural, and there are rural numbers that the lenders have as well. Energy efficiency. This one, it's important to note that CMHC is making a change, and they have announced it already, where as of September, end of September, they're changing the guideline for the energy efficiency. They're actually increasing it. The numbers we have here are for the new guideline. So to get your points, you'll need to provide, well, to start off, the current benchmark actually is based off the 2015 National Building Codes. As of September, that's going to move to the 2020 Building Codes. And the second change is now you're going to need to provide more energy efficiency per level in order to get the same amount of points. Here we're showing you what they're going to be as of September. If you want level 1, we need to provide 25% better for the National Energy Code for building, or 20% better than the National Building Code. Which one do you use for your project? Is it the 25% of the 20? Well, that's going to depend on the size of your building. CMHC puts it for the National Building Code. So for the NCB is going to be for low-rise properties, and the NECB is going to be for high-rise properties. Level 2, you'll need 50% better or 40% better. And for your max points, you'll need 60 or 70% better, depending on the size of your building. And right below here, we had the flexibility. So depending on your scoring, how many points you get, what will CMHC allow you to have? If you have the 50 points, you'll get your 95%. You'll only get 40 years amortization, and you'll have to provide full recourse, which means 100% during construction and reduced to 40% when you're done. 70 points, again, you'll have your 95%. You'll have a higher amortization at 45 years. And again, you'll have your full recourse. And the maximum amount of points at 100, you'll have your 50 years amortization. And at that point, you'll be able to request a non-recourse. It is just requesting it, right? CMHC could always refuse it, but at that point, they consider it. And when they're comfortable with the borrower, they will allow for non-recourse loans, even though you're above that 65% loan to value. And the last program I want to touch base on, this one is a bit less known. It's the Apartment Construction Loan Program, the ACLP. This program is it's not directly with lenders. So typically, if you ask your lenders, they're not too familiar because CMHC is not the insurance company in this program. They are the lender. They're the ones funding the deals. In this program, you can get up to 100% loan to cost for your residential component, 75% for commercial. Loan advancing, again, don't hold back. So you could get 100% during construction. Debt service coverage ratios are going to be the same as the MLI Select, which is 1.1 for residential and 1.4 for the commercial. And interest rate, this is where it's a bit different. Actually, it gets better. So the applications, they're not qualified simply on a ceiling rate. We're not the same ceiling rate. They're qualified at the higher of 2% or CMHC's rate plus 1%. In all cases right now is going to be the latter, which is going to be CMHC's rate plus 1%. When this program was first put in place, CMHC's rate was below 1%, which is why they had the either or. But as of today, CMHC's rate is closer to 3.25. So they'll be qualifying deals at 4.25. But your real net rate as of today is near that 3.25 mark. How does the rate work in this program? Well, it is a fixed rate. There's no option for the floating. And it starts right at the beginning of construction. When you start construction on your first draw, they're going to lock in your rate for your entire term. And the first term is a 10-year term. So even though you're not stabilized, you're not done construction, they lock in your rate for 10 years. But during construction, you're still going to be paying interest only. So it's much better than typical construction where you're prime plus. Here you're going to be at CMHC's rate, call it 3.25 today, interest only. And then when you're done construction and you're occupied and stabilized for 12 months, at that point, you'll be paying your capital and interest. You could also get the 50-year amortization depending on scoring in this program as well. And some small advantages and some quick notes on this program as well. In this program, there is no CMHC premiums. Well, they're not passed to the borrower. However, the taxes on the premium are passed to the borrower. So you are making some savings there. The interest rates are generally lower than MLI and MLI Select. As I mentioned, CMHC's current rate for this program is close to 3.25. On the MLI and MLI Select, depending on deal size, you're probably closer to 3.5 to 4.5, depending on deal size and location. And for the recourse, well, once you're rented up, and if you've achieved the rent you said you would, you can make a request to have the loan become non-recourse as well. And to finish up on this, some notes is that, like I mentioned, CMHC is not insuring this loan. They are lending directly, which is why we have some cheaper funds. However, because of this, it's a very competitive program, right? Once you submit your deal, you become in competition with every other deal submitted across the country. And CMHC is going to pick the best deals every month. So every 30 days, CMHC goes through every request received, and they'll pick the top ones received for that month. If you're not picked, you can decide to stay in for the next month, see if now you're better than whoever is left plus the new ones, or you can withdraw and apply in a different program. You can't apply in multiple programs at the same time. CMHC will just cancel both and tell you to pick one. Ways to optimize and help you get picked. Well, CMHC actually prioritizes the strongest applications, of course, based on the scoring, and those who deliver desirable rental supply and social outcomes. And they're actually encouraging the clients to include accessible units because it's not a requirement to have them, but you'll get more points if you do, to commit to deeper levels of affordability. And I want to touch base on this specifically because it's important to know that you might qualify for the program, but just qualifying for the program doesn't give you points. You have to give more to get points, right? For example, for the affordability, they might say your affordable rents is $2,000 a month. However, you won't get points for $2,000. You have to be even cheaper than that to start getting points. You have to commit to a higher proportion of units as affordable, right? Providing the minimal amount of units isn't enough. You'll need to provide more to get more points. Committing to longer affordability, committing to greater levels of energy efficiency, support community-oriented solutions, working with partners, mainly municipalities, cities, provinces are partnering around with you, and providing a unit mix that supports family size units. They don't just want a lot of small units. You'll get more points if you tend to family size units as well.
Okay, great information, Alex. That was a really good overview. Now, there's a lot of information in there, and you're drawing out a lot of questions from the audience. Some of them have been answered already. We're going to try to tackle some of them at the end of the webinar. But before we move on to Nav, I just wanted to ask you really quickly, Alex. So, when should a developer immediately think CMHC, and when should they pause and consider alternatives?
In my opinion, and as a broker, what we do with our clients is every single deal we consider all of them.
Okay.
There's no easy way to say this one's going to fit here, this one's going to fit ACLP, this one's going to go conventional. You have to run each performer every time and figure it out because a lot of times you'll be surprised to say, hi, this one for whatever reason ACLP works, or on this one, it's MLI Select or even conventional, because conventional, we didn't talk about it, but it is also very, very good right now. But our recommendation is just speak with your expert, with your lender, with your broker, and go through all those options. It's definitely not a waste of time, and you'll learn a lot doing so.
Yeah, and I think, that is the advice that we give to our clients is to seek the advice of a broker that could go to the field and bring back options and do a side-by-side comparison. And it actually that lends us nicely into the next section. I'd like to bring Nav on to talk to us. And Nav, you're going to walk us through a case study, but first give us the 10, 20-second elevator pitch on CFO Capital.
Thanks, Dave. Yeah, we will be getting into a case study. My name is Nav. Dave introduced me as Navendu earlier, very formal Dave, but call me Nav. Totally good to go. Um, CFO Capital is a boutique commercial mortgage broker, active across all types of asset classes, particularly these days, especially the last few years on the multifamily construction, as has been the flavor the last few years. Um, let's get into this. Before we actually get into the case study, let's take a stock of the situation, not as fun as the State of the Union last night, but just in terms of where the market is. What has been the situation thus far? Let's say over the last 2 to 3 years. If in mid 2024, early 2024, if I was asked the question from a financing standpoint, what is the strategy? I think the answer was CMHC. That was really the only right answer at that point. Um, but I think that the last 12 months, and especially after the changes in July 2025 that were brought about by CMHC, I think that everybody should pause and consider their options. And the good news is that there is plenty of options, and we'll go through that in a moment. What's been happening in general? Clearly, there is downward pressure on rents. We are seeing that. We're reading about it in the headlines. Your operating costs are what they are. They're sideways or maybe going up a little bit. What does that translate to? Potentially a lower loan to cost and a greater capital outlay from your side. The higher premiums are not making it easier. It just means that the break-even point to actually justify paying those CMHC premiums isn't as straightforward as it used to be. So the headline number of 95% financing or 100% LTC, yeah, in theory, it's still there. But there are other constraining factors, that being your debt service cover and exactly how much loan your property, once stabilized, can support. Like that's really the crux of it. And that's the big constraining factor that you'll run into in most situations, unless your cost base is extremely low. It's not the situation quite there yet. So DSC and your debt coverage is still the big constraining factor. The select program is limiting you to 75% during construction. That 85% number is becoming 85-90% is becoming a little bit harder to achieve. So all in all, it's not a straightforward path that go straight to CMHC head on. get the COI, get into constructions, because the lenders out there have varying opinions. When we go and tender out the debt, we are getting a 20% difference in loan amount, in pricing, and just the way the lenders assess your file. When it comes to say the rental levels, it's almost become a bit of a stigma to discuss that there will be rental growth over the next 3 to 4 years in the context of CMHC. But conventionally, there is a discussion to be had. I think there's more flexibility. So good news for 2026. It's not all doom and gloom. The conventional lenders are getting creative and finding ways to put their capital out. They've been on the sidelines. Remember, the last 3 to 4 years have been all about CMHC insured. And this market had moved away from the conventional lenders, but I think in some ways it's getting back, um, on account of them pushing the envelope a little bit. So we are seeing loan to cost from conventional lenders touching potentially 85%, them getting high, offering higher amortizations, lower rates, and willingness to work with you and be flexible for your project, which you may or may not see from a CMHC insured option today, right? So this is in today's context. So if your pro forma, when you run it, is extremely sensitive to interest rates, I still think that there's nothing that beats a CMHC insured interest rate. But let's say on the other side of it, you want to get into the ground in the next 3 months. Maybe you see supply coming in your market. You want to jump ahead of that supply. You want to get your building built before that and leased up before that. From a timing standpoint and a flexibility standpoint, I think you have to straddle conventional. The idea always is plan ahead, have a roadmap ahead, engage your advisors early, work with the wonderful team at SVN. We'd love to work with you. And that being said, let's get into the case study. So the overall note that I would offer is there isn't a one size fits all program. There just isn't. ACLP sounds fantastic when somebody says you can get 3.5% construction financing, fixed rate for 10 years. You get no premium, but is that the right program for you? What does that require? On the other side, is MLI the best program when they're constricting you to 75%, or is conventional, the con in conventional being the higher interest rate that you'll end up paying? It's up in the air. So let's start right at the top. Let's talk about affordability. Why are we starting with affordability? Because what affordability level you offer ties into your income, ties into your net income, ties into the debt that you're going to get, and that ties into your equity outlay, and ultimately how much money your project can generate for you. So it's a chain. So let's start at the top at affordability. When we talk about affordability, there isn't a singular definition. To make matters more complicated, there isn't a single definition for affordability. So the affordability definition in the ACLP program is quite different from the affordability definition in the MLI program. The affordability in ACLP says we're looking at the median household income. MLI says median renter income. Okay, we've given an example of the city of Toronto. The case study that'll follow is from a file that we are done for a project in the city of Toronto, and that's what we presented. So the median household income for city of Toronto was 102,000. The median renter income is literally half of that. So right off the bat, you have the difference that's being created. MLI says at least give me 10% units in the affordability program at 30% of that number. That number being 53,900 translates to a per unit affordable rent of 1,348. $1,348 per month is your affordability threshold in the MLI program. ACLP says 30% you qualify, but as was being alluded to earlier, qualification isn't enough. You have to offer deeper and wider. Deeper as in 30%, not 30% of the median household income, but think 20% of median household income, and offer it not just for 10%, consider 25 to 30% of the units, and offer it for longer. For ACLP, you may be offering 20 years of this affordability. In the MLI program, you might be offering 10 years. On the other side, the conventional and the MLI, call it the market standard, whichever word you want to use, they don't ask for any affordability. You peg your rents to market, whatever the market can afford. You peg it to that, but then you give something away. One hand giveth, the other taketh away. That's the logic here. So let's go to the next slide here. As you can see towards the right, there are 4 columns. One speaks to MLI Standard, ACLP, Select, and Conventional. This was a 60-unit project in Midtown Toronto that we had worked on, and this is a case that we had presented to the developer there. As you can see, this one did not have any bachelor units. It's 1 bed, 2 bed, 3 bed, fairly simple. Right off the bat, you can see that the ACLP number is trailing everybody else in the 1 bed. So $720,000 being what this developer believed could be earned for their 1 bed unit, but ACLP limiting you to 30% of the units at 20% of the median household income was bringing that number to $577,637 for MLI. You come down to the total rent, and you can see the difference manifest there. $2.2 million. What was the potential income versus the discounts that you have to offer in ACLP and MLI. So conventional and the standard program are allowing you to earn a little bit more top line income compared to the 2 programs that require you to provide affordability. That is ACLP and Select. Let's work our way down, assuming a common set of expenses. Sorry, we just go back to the slide 1 second. Yeah. Assuming a common set of expenses, more or less, the similar difference that you saw in the EGI carries through to the NOI. This NOI, as you know, and we can go to the next slide, please, Sarah, will make itself apparent. This difference in the NOI will make itself appear in the debt that you're sizing up. So what are the components when you're sizing up your debt? Of course, your NOI, what the DSC test is, and I'll come to this in a second, what the interest rate you're testing on is, what the amortization is, and anything that's program specific. I said I'll come back to the DSC test. MLI Select and ACLP say, okay, we're going to divide the net operating income that we are arriving at by 1.1, and that becomes the maximum loan or maximum debt servicing that we'll allow the loan to carry, and we're going to reverse engineer a loan amount based on X interest rate, Y amortization. So we've put together just some example what the MLI program number there was. MLI Select and MLI Standard offer the same takeout interest rate. We tested it at 4%, and we tested ACLP at 4.5%. Why did we test at 4.5%? Just a quick note here. It's because CMHC says you have to add 1% to the 10-year GOC, which was at 3.5% at that time. So we tested at 4.5%. You come down to the total debt number, and you're seeing a slight difference in, call it a $2.5 million debt difference between most of these programs. Bear in mind that the cost of this debt, come to that on the next slide, the cost of this debt also affects the total budget, and the LTC is right there. So in this specific program, again, I want to be clear here, your site could offer up very, very different numbers, where let's say ACLP could be the one that comes out on top. It comes down to a unit mix, comes to the location, what rents that you can achieve. It's really really site and case specific. So in this case, the best offer here was indeed sorry the MLI Select. My apologies. That was the best outcome here, and that's the one we had gone with. Um, and the rest of the slide just follows in what was the value that could be achieved based on a certain cap rate, obviously linked to the net operating income that we had talked about on the previous slide. Go to the next one. Okay, so we were talking about earlier how there's a factor of premium. So MLI Standard has a premium. MLI Select has a premium payable. ACLP is for the lack of just to keep it high level, it doesn't invite a premium, and conventional obviously doesn't invite a premium. Why is premium important? Why are we talking about premium? Premium is a payment that you'll make. You'll make it, let's say, if you have a 50-year amortization, you'll be amortizing that premium over that life, over a 50-year period. So it does not get debt tested. So the fact that a program is going, you have to pay a premium on it, does not get tested in your calculation when it comes to sizing up the debt. That's the good news. The bad news is that you still have to pay for it, and you're going to pay for it after your principal and interest payments. And that can take away the money that was ultimately supposed to flow in your pocket. That's going to be a little bit less than when you account for the premium payment. So the annual debt servicing, including premium, is a big number, in my opinion, to consider as to how much you're paying for to service the debt and the premium, and ultimately, what are you left with? You've taken out your operating expenses, you've taken out your P&I, and you've taken out your premium payments. What do you get? What do you get at the end of the month? What is it? What's the end objective here? Just below the premium, we had calculated financing estimates. Financing estimates obviously tie into the total cost. There are different construction interest rates for each of these programs that we have laid out. That will obviously determine the financing budget. That ultimately determines your total budget, which also affects how much equity outlay you have to do. So the big takeaway here is when you're sizing up your debt, which option is it that requires the lowest amount of capital outlay? That's the objective. And how much money do you get to keep in your pocket? Because otherwise, what's even the point? Last slide from me. So my main takeaways here in this presentation is that there is no singular panacea solution, and I think each situation is very different. Now, I've been talking to a lot of developers, and they're all interested in MLI Select because it's that 3.5%, the 10-year GOC construction rate is very attractive. But I think you have to really put things into perspective. That indeed is a superb proposition. You have to also consider what you're offering to CMHC in exchange for that. Do not negate conventional. You must look at conventional. Evaluate your avenues, evaluate them early, and plan accordingly. The best news that I can offer is that you have options. It's not a single lender market. You have options. Consider them all, and options is power. And my last thing that I'd say, my opinion or a hot take, as kids call it these days, is that in my opinion, we're living through what we're going to call in 5 years' time the good old days. Why am I saying that? The costs are way down, and I think you guys as developers know this better than me. The costs are way down. It's going to be a blip. The starts have really tremendously fallen off. But that's good because we are seeing across the board on the hard costs reductions. Everything that's being tendered is coming out to be less than what was budgeted. So my view is that in 2030 or 2031, it's going to be similar to 2018 or 19 when guys in 2022 and 2023 were saying I should have started back then. I feel like that's the situation we are in when you're not going to find costs coming down to the extent that they have come down for a while. Thank you very much. The next two
Yeah,
slides,
Nav.
sorry, just the next two slides. I'm not gonna go through them. I'll leave them if you circulate the slides, Dave. Just
Yeah,
comparison
maybe
across the programs.
give us a real quick overview, Nav.
Um, Go back to the construction slide. So here we are comparing it's just a snapshot, not very, very detailed, but just a snapshot of what loan to cost. And these are headlines again, not specific, it's just headlines. What interest rates are being offered right now, the terms, the fees that accrue to each of these, what premium you're paying, what amortization you can get, and what DSC you'll be tested at. This is for construction. And on the next one, the term, if you're, let's say you already are, you're only looking for takeout financing, ACLP doesn't figure there because ACLP is specifically for construction. So ACLP is not an option here, but if you were to go standard takeout, MLI select and short takeout, or a conventional takeout, what the LTVs, interest rates, the term, all of that, what we are seeing out there, I think I've seen this question also pop up, what interest rates are, the current level of interest rates. Hopefully this gives you an overview.
Yeah, now this is a great overview. And again, we're getting tight on time here, but this is really good information. We are going to make the recording available so that people can take some time to consume this information and more at a greater length. But we're going to transition now. I'm gonna introduce now Joanna and bring her to the table. Joanna's going to talk to us about strategies and insights. And Joanna, really quickly, give us the elevator pitch on what you and your company offer.
Yeah, sure. Thank you, Dave. Hi, everyone. Thank you for having me today. My name is Joanna. I'm a commercial mortgage broker specialized in CMHC insured financing. I work primarily with apartment developer across Canada. My role is actually quite simple. I help developers financing so the pro forma can work, project is financeable in today's market environment, especially when construction costs, interest rate, and like loan policies requirements continue to change. That's my introduction. Thank you. So
Thanks, Joanna.
yeah. Thank you, Alex and Nave. Like we already had a very great overview from Alex and Nave. They walked through how CMC program work, the program structure, amortization, key requirement. But today I want to look at this from a slightly different perspective. So instead of focusing on program rules, I want to focus on how developers can actually use these programs in real life. Because in the end, developer doesn't build spreadsheet, they build projects. So yeah, so more importantly, I want to show how CMC financing can work together with municipality incentives to improve feasibility and reduce active requirement in the end to increase our development return. So let me start with a real case study. This is it's a very small 10 units development in GTA, but the strategy works for bigger project as well. For 10 units, you just multiply the numbers to 100 units or 200 units. So just one, because this is a good example to show how the program works. So I just take this very simple example here. So this is like a good 10 unit apartment development in GTA. So I work closely with the client across from very early. Like many developers today, they were facing a familiar question. The project makes sense operationally, but financially, the margin was very tight. So this site in Toronto, location is strong, in a very good location. So rental demand is strong. The unit mix is good. They have bachelor, one bed, two bed, three beds. So fundamentally, this is a very typical missing middle in GTA. If you know GTA, so a lot of smaller developers, they are just building from 5-plex to 6-plex in Toronto. It's very easy to get approved, and construction cost is relatively lower. Yeah. So, so the key question is quite simple. So how do we structure the rent roll to maximize financing outcomes and but still keep the projects attractive to investors with a good return? So we explore three different approaches. The first option was very straightforward. We use market rent, which we can get the highest NOI, net operating income, so that our valuation will be the highest. The option two, oh, by the way, the developer has already decided to do energy improvement. They will spend cost on this here so that they will get 50 points under MLI Select. So, okay, so option two is we consider the loan requirement from CMHC. Let's say to achieve another 50 points under MLI Select, we need another 50 points. So 10% of the the rent should be under CMHC's affordable rent, which is 1,347 in Toronto. So this is just like one unit in this case. And option two and option three is actually suggested by the developer himself because he worked with the City of Toronto. If you assign more units, like 20% of under city affordable rent, you can get a big waiver of your development charge. So here is the difference from the valuation point. We can see like option three is the best. That's why a lot of developers don't want to do affordable, right? So next slide, please. Yeah, so however, in these slides, you can see because they are using different loan program, they are getting different NOI, they are getting different loan amount as well. So actually, option two give us the highest loan amount. However, option three is getting not the highest loan amount. However, option three they have a cost in saving in terms of energy improvement cost, and also they get like a big waiver in terms of development charge. This make a huge difference. So from based on the loan amount and the construction cost, the equity required for this project is quite different. So you can see with 1 million equity, if we use option one, we can only build like one project. But if we use option three, we can actually build three projects. It's like 1,300,000. So that is like a big difference. Next slide, please. So here I just dive a little bit about like the development yield, which is quite similar number developers very familiar with. They want to get higher development yield, right? So the spread usually represents the development profit of a project. This is development yield minus the exit cap rate. So yeah, just a little bit explanation of the development yield. It is the net operating income divided by total development cost. So from here, it's just like from the last slides, we can see option three has the highest development spread. So like based on this case, we can see we have same building in the same market. We didn't change anything about the building, but we get 38% increase in development profit. I hope like what is our takeaway from this case is like CMHC programs are not simply like a loan program, a mortgage product. They are capital strategy tools. Like in the case we just reviewed, like nothing about the building change, not the location, not the market cap rate, but by strategically structuring the rent roll, optimizing capital structure, and we incorporate municipality incentive early, like early at the very beginning at the planning stage, the equity was reduced like by 70% and development profit increased by 38%. So the the investor return would be significantly improved based on right structure. And what is our takeaway here is always start planning planning what financing program we are going to use as early as possible, even before you start like feasibility study, because or at least together with feasibility study, like many developers will use Rock Advisors to provide feasibility study, right? Usually we will focus on the future rental profile, like what will be the unit mix and what amenity we should do. But at the same time, I would suggest every developers to also think about the loan program. So just by combining, because from this case, you can see like we can structure the rental, and at the early stage, it's not like you give us a rental and it's not going to change. So when we plan that early, everything can happen. So I would suggest everyone to optimize your capital structure together with feasibility study. So yeah, that's my first case to share today. Next slide, please. Okay, let me walk you through another real example. Okay, this is not exactly like the construction loan for new construction, but it includes a renovation or construction change in acquisition financing. So I want to show everyone, like from this case, we can see how capital structure can help us change equity required, risk, and investor returns. This is a real case, but that was back to 2024. We submitted this case before the July 2024, before the energy efficiency points change. Means we are getting 100 points under energy efficiency. So so we are still getting 95% loan to value under CMHC. Okay, so a little bit background of this purchase. Like my client would like to purchase a 150 townhouse portfolio in Kitchener, Ontario. The project is a little bit old with the purchase price is around 330 million. It has 10% vacancy. So they want to use the value add strategy, like vacancy for value add project is good, especially in like province that has those rent control. So if let's say if we're in Ontario, we were BC, we would love buying a property with existing higher vacancy, like we can finance this project in a better way. Yeah. So we need to do some capital improvement of this project, and also there are some energy upgrades to getting the 100 points and the MLI Select back to 2024. So the total estimate, the construction or renovation tranche would be around 6 million. So typically when we are doing a value add strategy, we always use bridge financing and CMHC takeout, right? Like this is like what we are always use. So if we are using bridge financing and CMHC takeout, what we can get is 75% loan to purchase price, and we might able to get 100% construction financing on the 6 million improvement as well, based on which lender we go to. But it is possible, as long as the total loan to cost is not like above like 85%. Yeah, so if we are doing financing this way, you can see the total equity required to close this deal would be 10.5 million, and the interest rate for bridge is a little bit higher, it's prime plus 2 to 4%, and back then the prime is not as low as today. It's like 5, you can see it's 5.45 back to 2024, and the lender fee will be at least 1% for bridge loan. However, I didn't structure the way use financing. I used another program called CMHC with CMHC. It is called Purchase Plus Improvement Program. I really think this is like underused program, but this program can work with every other program. It's not so let's say MLI Select, MLI Standard, they are this purchase and improvement program is just a loan structure. It can work combined with MLI Select and MLI Standard, because that we're talking about is just about how we calculate the loan amount. This is the loan structure. So even now we can use this program as well. So for this program, we are able to get 95% loan to purchase price because we are getting 100 points and the MLI Select program. And we get 2 years to complete those energy updates to getting the another tranche of the construction financing. Yeah, like they were typically like typical construction loan, they can use like CMHC or the lender will have you to use quantity surveyor to monitor the loan proceeds. You will need to do the loans per draws, but it's still workable. So under this program, we only need 3.3 million to purchase this project. So can you imagine? You can only use 3.3 million to purchase a 36 million portfolio in Ontario. So it is very powerful if we structure the loan amount in a good way. Yeah. And in terms of interest rate, it will be much lower. It's like 4.3 fixed for the first tranche, the 95% purchase price. It's 50-year amortization upon closing. And for another tranche, the construction financing, it's like, because with CMHC's insurance, lender would like to give you lower rate loan. So that is just like prime. So prime loan for the construction tranche, and the lender fee is much lower than traditional bridge financing. Yeah, like so we can see like by using right program to acquire a project, like we can get the equity required is lower by 70%, and you can imagine the investor IRR would like to triple, right? Yeah. So just a little bit more consideration under these two different program. For some smaller case, maybe bridge loan and CMHC financing takeout still workable because you are potentially because you by doing that, if you are doing value add at like it's very strong, you might be able to pull off all the down payment and the construction tranche back, or maybe you can get more money back for this one. But like for smaller loan, the interest a little bit higher interest rate may be recovered from the equity takeout in the future. But for the CMHC purchase and plus improvement program, the initial equity so for the down payment, for the a bit like closing costs, it remained tied in the project until next refinance. So that is a little bit consideration but it's just like lower the equity to 3.3 million. It's very powerful, and yeah, some developers or some operators might don't like very higher leverage, so this might be a good case for you as well. And more importantly, for this one, we submitted just before July 2024, before the policy change. So we are able to lock the policy when we make the application. Otherwise, if you are doing bridge, then you were just like in the next year, you are ready for refinance, you can only get 50 points to use, so that it were like your amortization were lower than 40 points, like 40 years. For this one, once you get the approval, just as Alex said, approval valid for the whole loan until you get your other things like until you get all the loan refinanced. Yeah, so this is another case I want to share with everyone. And oh yeah, thank you. So here is we might have a little bit brainstorming about like how we can use this program. Let's say purchase and improvement and refinance, and this can also use as refinance plus improvement. So I can make a case in my mind. Let's say you are a developer, you have a 100 unit building which has been with CMC almost 10 years. It's almost time to refinance, but you will need a big capital improvement cost incurred to help you achieve higher refinance proceed with CMC. Some developers might not have that type of money, especially when your project is big. Because I used to have a client reaching out, which I explored that for the 300 units he owns, he will need like around like 20 million. No, it's like 25 million to put into the project to do capital improvement and renovation to add value, etc. So you can consider using this refinance plus improvement combined with some currently available, let's say MLI Select, like we can still use energy efficiency getting 50 points before September this year. And for some of the other city, you can, let's say if you are in Alberta, you can still get good utilization of affordability there, because affordability works quite well in Alberta. So yeah, so this is just brainstorming to see how we can use this program for your existing portfolio or purchase projects in the market. Okay,
Yeah,
next slide.
thanks, Joanna. And to your point, you've mentioned a time block coming up in September. So maybe give a quick overview of this last slide.
Yeah, for sure. Yeah, exactly. Yeah, so this is like what Alex also mentioned, that MLI market program, it's maybe works. So I just would like to give you a quick update. So before July 2024, we can like a lot of GTA projects using MLI under energy efficiency, so they are getting 100 points. But after July 24, they can only get 50 points and 40 years amortization. However, we can consider, and July 2025 is another change, is that CMC increased the premium for MLI Select dramatically, which is basically the MLI Select program almost has the same insurance premium with the MLI market standard. So that's why we can see, I want to show you like how the loan amount will be different under different program. Let's say if we are just doing a 5 to 6 unit development, we can see MLI standard will still offer debt servicing ratio is 1.1, but they can offer 50 years amortization for new construction. So for this type of projects, actually using MLI Select is you are achieving a little bit higher loan amount. However, if you are building bigger size project, if you want to use 5-year term, which is most developers would like to use these days because 10 years is much more expensive, your loan amount would be a little bit lower. Like let's say if a bigger project is lower by 5 million, because the DSCR is 1.3. Unless you want to use 10-year term, which the amortization is higher and like you can get almost the same loan amount under different program. So but I also want to mention another point, like even for the 5 to 6 unit development, we are getting higher loan amount under MLI standard. However, we need to pay attention to for construction, the loan can only be advanced up to 85%. It means during construction, still the equity required to do the project is still like 15%. If you don't have that amount, you will still need to use energy to get MLI Select approved to provide you less equity to start this program. So the key is, if you are still would like to utilize the energy efficiency and MLI Select, even those 50 points, just submit the application before September 2026. And don't wait until the deadline. The deadline will be super busy, brokers are busy, lenders are busy, and the timeline will be long. Like always plan to submit maybe like right now the turnaround from CMC is super fast. So yeah, so this is today my presentation. Hope we can get some insights here. Thank you.
Joanna, thank you. That was an excellent overview of some strategies and real life examples. I've got one question here, and I know we're well over time, but most of our audience has stayed with us. And obviously, we've got our three panelists that are interacting in the chat. But Joanna, the question that was just asked is what happens after September 2026, right, as it relates to the
Oh, it's just the MLI Select change the energy efficiency points. So for smaller building, they are becoming more and more difficult to getting energy points. Yeah, if they
Gotcha. So
are,
the
yeah.
standards changed after it just becomes more stringent. Think this is one of the things that is most challenging for our developer clients and our participants is things are always changing, right? Which is why it's very timely that we do informational sessions like this, but we have to keep the conversation flowing. Now, because we're so long over time, and our panelists. And again, thank you, Alex, Nav, and Joanna for staying on top of the chat questions. Anything that we didn't have a chance to address during the webinar, we'll take those offline. We'll get the right expert to respond to these questions and get these answers back out to those that were kind enough to submit their questions. And if you have any questions or projects you want to talk about, you can reach out to me. I can connect you with one of our experts that are on the panel to talk more in depth about these programs and how it applies to your projects. So thank you for your attendance. I really appreciate everybody sticking around with us. I thought it was valuable that we took a little bit extra time because there's so much detail here and it's so impactful. So thank you, everybody. We'll be in touch and don't hesitate to reach out with any questions.